Welcome everyone to our next talk by Vertex. We've got Peter Boerhof, the VAT Director at Vertex. Peter is a seasoned VAT specialist who has gained expertise from both the Big Four and in-house roles. Within Vertex, Peter provides VAT insights on global trends and requirements across the globe. In his spare time, he enjoys traveling, doing sports like cycling, running, kickboxing, and enjoys a bit of food and drink with his friends and family. Welcome, Peter, and excited to hear your talk about VAT, especially around the changes that are going around in our region with Brexit. So, yeah, over to you.
Yeah, thanks, Janak. Welcome. I have the honor of providing you with some guidance on the changes of e-commerce businesses may be facing as of July 2021 as a result of changing VAT regulations for cross-border sales to final consumers. Dependent on the business model, these changes can be quite impactful on displayed pricing, calculating and reporting VAT across Europe, and data you may need to collect. I hope to create some level of awareness of what is coming, so e-commerce vendors and marketplaces can take appropriate action in time. And I need to stress that this only applies to sales to final consumers and not to business sales. And I have to put in a little disclaimer here, and that is that these slides are based on the quite messy EU regulations that have been published now, and they consist of a number of directives and implementation regulations that need to be read in combination and still need to be translated in national legislation in each of the EU countries. And as the EU rules are not clear on every possible transaction, chances are there may be different translations and/or interpretations. But let me first introduce myself a little bit. I'm Peter Boerhof, and like Janak said, I joined Vertex last year in November as the VAT Director for Europe, but also with an eye for non-European VAT and similar taxes. In this role, I provide VAT guidance to colleagues and customers and provide thought leadership on global trends in VAT. Prior to joining Vertex, I was the Global Indirect Tax Lead responsible for VAT and customs with one of the large Dutch multinationals. In this role, I've been focusing for many years on tax data, tax processes and automation. Amongst others, I initiated and managed, of course together with IT, the implementation of VAT automation projects. I ran a VAT reporting outsourcing project and participated in several business restructuring projects. Today, we are going to discuss why the VAT rules for the EU are changing and what these changes mean for business to consumer sales within the EU, but also for such sales for goods coming from outside the EU. And as marketplaces often play an important role in facilitating these sales, I will also discuss how they are impacted. And finally, I will discuss some scenarios in order to clarify some of the more practical implications. So why do we actually need to change the VAT rules in Europe for business to consumer e-commerce? The first reason is to solve distorted competition with non-EU vendors. As consumers, we all know stories of how to buy low-priced products online in China and save some money here, as this is much cheaper than buying in a regular bricks and mortar shop or even a European web shop. One of the key reasons these products are cheaper is because of VAT and import duties not being collected on these goods, as there is an import exemption for goods with a value below 22 euros. EU vendors, on the other hand, have to collect VAT on their sales of the same goods. So this is to create a level playing field with non-EU vendors. The second reason is to create a level playing field within the EU. If a Danish customer buys a book in the local bricks and mortar bookstore, the price of the book will include 25% Danish VAT. If this customer buys the same book online at a small UK web shop, there will be no VAT collected at all. As VAT rates differ across the EU, it makes quite a difference if you buy something with 25% or with 15%, or even without VAT. This distortion is caused by the fact that local bricks and mortar shops always have to charge local VAT, while e-commerce vendors from other EU countries only have to apply VAT of the country of destination if their sales to that country exceed 100,000 euros. And finally, the changes are introduced to reduce the VAT compliance burden for EU e-commerce sellers whose sales exceed 100,000 euros. Under the current rules, they will need to register and report VAT in multiple EU countries. In addition, under the new rules, also smaller e-commerce vendors will have to report VAT in multiple EU countries. In order to avoid a significant increase in the overall compliance burden for e-commerce vendors, a one-stop shop VAT return will be introduced. Via this return, all EU VAT on distance sales to final consumers can be reported via this special return to the home country tax authorities. And they will distribute the VAT collected to the various EU countries. So on a high level, what are the changes that will go live by the 1st of July 2021? There will no longer be a VAT exemption for low-value goods below 22 euros coming from outside the EU. All EU vendors with cross-border sales to final consumers that totally within the EU exceed 10,000 euros will have to calculate and report VAT in the countries of destination. This VAT can be reported via a new special one-stop shop VAT return to be filed in your country of establishment or registration for non-EU vendors. There will be an introduction of a special VAT reporting facility for imported goods. That's the import one-stop shop for goods with a value below 150 euros. Logistics service providers will have to collect VAT for far more goods. And finally, marketplaces for VAT will be considered sellers for specific transactions facilitated via their platforms. And all of these details will come back in the examples we will discuss later on. Let us now first take a closer look at sales to final consumers of goods that are already present in the EU. First, we want to neutralize the difference in VAT treatment that currently exists between cross-border sales and domestic sales. This is done by arranging that local VAT is almost always due if a final consumer buys from a foreign vendor. This is accomplished by the abolishment of the current distance sale thresholds of 100,000 euros or 35,000 euros. That's also applied in some countries. And I say almost, as very small vendors that incidentally sell cross-border and who do not generate an annual revenue over 10,000 euros from these sales can still apply the VAT of their home countries. As under these new rules, way more vendors have to collect VAT in the countries of their customers. The second measure will ensure VAT of the various EU countries can be reported via a single one-stop shop return in the country of establishment of the vendor. In this one-stop shop return, a vendor reports all VAT on distance sales to final consumers to the various EU countries, and this is filed through the platform of the home country tax authority. And the local tax authority distributes the revenues to the various EU countries for which VAT was reported. So what can this mean in practice? Let's assume in this example we have a Dutch vendor selling to final consumers in France, Germany, Italy, and Sweden. The sales to Germany exceed the current distance sales threshold of 100,000 euros. So German VAT must be collected on those sales. France and Italy apply a lower distance sale threshold of 35,000, and for both countries, sales are above. So also here, French and Italian VAT must be reported. Only for Sweden, the sales stay below the threshold. And as a result, this Dutch vendor needs to register for VAT in France, Germany, and Italy, and file local VAT returns. This also implies having to communicate in local language and being audited locally, which can be quite a pain. For the sales to Swedish customers, the vendor must report Dutch VAT. So those are the old rules. Under the new rules, the position of the Dutch vendor will change. This vendor has a revenue of over 10,000 euros for cross-border sales to consumers across the EU. As a result, he will have to calculate and report French, German, Italian, and Swedish VAT, and this can be done via the one-stop shop return in the Netherlands. There are some challenges and considerations here. First, of course, there is a transition. Under the new rules, the vendor also has to calculate Swedish VAT in this example. This needs to be embedded in an ERP system used, but also pricing need to be considered as the VAT in Sweden is 4% higher. Another consideration is that a one-stop shop return can only be used to report VAT on sales. So VAT on purchases cannot be reported in this return. So if the vendor in this example incurs input VAT on, for example, the rent of a warehouse in Germany, he would have the option to keep the German VAT registration and file local VAT returns in Germany. However, in this example, most probably he would even be obliged to keep the local registration if he ships goods to his German customers from the German warehouse, as these sales do no longer qualify as distance sales, but are just plain domestic sales. And finally, vendors that under the current rules stay below the threshold of 100,000 or 35,000 euros for the respective countries are likely to exceed the overall 10,000 euros threshold. This results in them having to understand the taxability of all products they sell across the EU and calculate the VAT in the country of destination. This can become quite complicated, as taxability and VAT rates for the same goods may differ. For example, bicycles are taxed at 5% in Malta, 12% in Sweden, and 25% in Denmark. And children's clothes are 25% in Sweden, but zero rated in Ireland. And this is where a tax engine like Vertex could come in handy, as the relevant rules across the EU are part of the software and are also maintained by the software provider. But also for goods coming from outside the EU, things will change. Low-valued parcels with a value below 22 euros will no longer be exempt from import VAT, and a new threshold of 150 euros will be introduced. For goods valued more than 150 euros, standard import rules will apply, and then in general, like nowadays, the logistics service provider will pay the import duties and import VAT at the time of importation to the customs authorities. And dependent on what has been agreed, the duties and import VAT will be charged onwards to either the vendor or the final consumer. For goods valued below 150 euros, a special import one-stop shop will be introduced. The import will be exempt for VAT, and VAT of the country of destination will need to be reported. So this import one-stop shop requires a special registration, so the registration number can be used during importation to check if the exemption can be applied. If this import one-stop shop is not used, then again, the import VAT will be collected by the logistics service provider. Also here a practical example. We have a US-based vendor selling into France, Germany, Italy, and Sweden. The goods shipped to France and Italy have a value above 22 euros. So for these goods, under the current rules, import VAT is due. The goods sold to German and Swedish customers have a value under 22 euros. So these goods are exempt for VAT under the current rules. Under the new rules, the vendor will have to monitor if the value of the goods is above or under 150 euros. For the goods shipped to French and Italian customers, the value is over 150 euros. So import VAT will be collected by the logistics service provider. The goods sold to Germany and Sweden have a value below 150 euros. And provided the US vendor is registered for the import one-stop shop, the import is VAT exempt, and German and Swedish VAT needs to be reported. If the US vendor, however, is not registered for the import one-stop shop, also here the logistics service provider will have to collect the VAT. The same rules apply to EU vendors selling goods that are being shipped from outside the EU directly to their customers. So the physical flow of the goods is leading and not the place of establishment of the vendor. Logistics service providers under this scenario will have to perform a lot more activities, and this triggers the question, who is going to pay for this? And there is still unclarity on some of the rules, like for example an import in the Netherlands without an import one-stop shop and a subsequent shipment of the goods to the consumer in Germany. And last, the big changes applies to platforms facilitating sales to final consumers. Under the current rules for VAT, they only facilitate and are not involved in the actual transaction. Under the new rules, platforms will be deemed sellers for VAT and will have to collect the VAT due in the countries of destination. But this will only apply to imported goods with a maximum value of 150 euros or to sales by non-EU vendors to EU consumers. All other transactions facilitated by a platform or marketplace still trigger a VAT liability for the original vendor. So distance sales within the EU by an EU vendor where the goods are shipped from an EU location to an EU final consumer are to be reported by the vendor in his one-stop shop return, even if the sales are facilitated by the marketplace. In this example, we have a large US-based vendor who sells goods via a platform to consumers in France. The US vendor is registered for VAT in France and reports French VAT. We also have a similar US-based vendor who sells low-value goods to consumers in France. As the import threshold of 22 euros is not exceeded, he does not pay any VAT. However, the Dutch-based vendor, who also sells low-value goods via the platform to French consumers, will have to report Dutch VAT on these sales. In order to tackle these differences, the VAT liability for platforms will be introduced. This can become quite complicated, because if a Dutch vendor ships from an EU stock to France, French VAT will be due via his Dutch one-stop shop return. If the Dutch vendor ships to France, French VAT will be due via a local VAT return. If the Dutch vendor ships from non-EU stock and the goods have a value below 150 euro, French VAT will have to be reported by the platform. If the Dutch vendor ships goods from non-EU stock and the value exceeds 150 euro, import VAT will be collected by the logistics service provider. And if a US vendor ships from a UA stock location, French VAT will be collected by the platform. And if the US vendor ships from his hometown and the goods have a value below 150 euro, also French VAT will be collected by the platform. But if the same US vendor ships from the US and the value is above 150, import VAT will need to be collected by the logistics service provider. So it can be quite a puzzle dependent on your business model. So let's have a look at some more, let's say, practical examples. In these examples, we will look at some scenarios of sales to private consumers in Germany by a German vendor, a Belgian vendor, a Dutch vendor, and a UK vendor. And please bear in mind that as the EU e-commerce rules will apply as of the 1st of July 2021, it is quite likely that we already have had the Brexit. So UK vendors are likely to be considered non-EU for VAT purposes under these rules. Let's first focus on the German vendor supplying to customers in Germany. Under the current rules, these are domestic sales for which German VAT must be reported in the German VAT return. Under the new rules, nothing will change, as this is not considered to be a distance sales for VAT. But if the German vendor has goods shipped directly from, for example, China to his customers, import VAT will be due on all of these goods. Under the old rules, this vendor could benefit from the 22 euro import VAT exemption. However, if the German vendor uses a logistics service provider or customs agent to take care of the imports and the goods have a value below 150 euros, the vendor can benefit from the import one-stop shop. In that case, the importation will be exempt and only German VAT on the sales is to be reported. So some questions that you should ask yourself here if that is your business. Will you register for the import one-stop shop? Will you include import VAT in your pricing? And do you expect your customers to pay this to the logistics service provider? Will you continue using drop shipments for imported goods, or will you run these through your own warehouse as the 22 euro exemption no longer exists? Now let's have a closer look at the Dutch vendor. This supply qualifies as a distance sales for VAT. So under the current rules, the vendor will have to monitor if he exceeds the 100,000 or $35,000 euro threshold. If exceeded, the VAT registration in the country is needed and local VAT is due, in this case Germany. If this threshold is not exceeded, Dutch VAT is due. Under the new rules, this will still be the case for small vendors that do not generate a revenue with cross-border sales of more than 10,000 euros. However, those vendors exceeding the threshold are required to calculate VAT for each of the EU countries where they have customers. And this VAT has to be reported in the Dutch one-stop shop return. But beware, sales to Dutch customers cannot be reported in the one-stop shop return and has to be reported in the regular domestic VAT return. Also, as mentioned earlier, the one-stop shop return cannot be used to deduct input VAT. So for countries where a vendor incurs input VAT, it might be better, if possible, to keep the local VAT registration. The 10,000 euro threshold only applies to EU-based vendors. So a UK vendor with a German VAT registration can post-Brexit not benefit from the 10,000 euro threshold. Under the new rules, like I said before, vendors need to know the taxability of their products across the EU. And this can become quite complicated with all the different rates and exemptions that can apply to the same products across the EU. Pricing to final consumers is inclusive of VAT, or at least it should be. So if you are a Dutch vendor selling a lot to the Nordics, as an example, where the VAT due is 25%, you may want to consider adjusting your pricing or accept a reduced margin. And now we take a closer look at the Belgian vendor who is selling through a Belgian marketplace or platform. Under the current rules, the platform is irrelevant for VAT purposes. So the vendor only needs to monitor the 100,000 or 35,000 euro threshold. Under the new rules, this is no longer needed as these thresholds are abolished. But for the rest, the generic business-to-consumer distance sales rule apply for this Belgian vendor. The marketplace will only be deemed seller for VAT purposes if the Belgian vendor sells goods via the platform with a value below 150 euros that are imported. So this results in a number of scenarios for the Belgian vendor. If the overall European distance sales revenue stays below 10,000 euro, he only needs to report Belgian VAT via his local VAT return. However, if the overall sales revenue exceeds 10,000 euros, in this scenario, he needs to report German VAT via the Belgian one-stop shop return. And for imported goods, if the goods are cheaper than 150 euros, German VAT will need to be collected by the platform. And if the goods are valued above 150 euros, German import VAT will be collected by the logistics service provider. So the marketplace or platform must implement various taxabilities for all goods sold via their platform across the EU. As a vendor, do you only sell via the platform, or is this just an additional channel and do you also sell direct? In case this is combined, different VAT regimes apply. Please bear in mind that your sales to the platform, who is the deemed seller, your sales to the platform are exempt for VAT. And in case you sell via a foreign platform, you will now have a foreign VAT registration. And this may change under the new rules, dependent on the arrangements that you will have with your platform. Now a quick look at the UK vendor. Assuming the UK vendor is no longer part of the EU, under the current rules, they have not benefited from the €22 import VAT exemption, as now they are still part of the EU. As the new rules for e-commerce will only apply as of the 1st of July 2021, and Brexit will probably happen by the end of this year, UK vendors can benefit from the import VAT exemption for the low-value consignments for a few months. For goods valued above €22, they will need to contract a logistics service provider or customs agents to take care of the importation. As of July, German import VAT is due on all goods with a value over €150, and this is likely to be collected by the logistics service provider. For goods with a value below €150, the UK vendor should register for the import one-stop shop, and then the import is exempt for VAT. VAT on sales to the German customer will be reported via a one-stop shop return in any of the EU countries the UK vendor chooses to register. The main point of attention for UK vendors is that Brexit causes that the UK vendors will have to assess the impact of the new EU rules twice. First at the time Brexit goes live, and for the second time when the new e-commerce rules go live. And finally, the situation where a UK vendor sells via a German marketplace. Under the current rules, the marketplace has no role, so the UK vendor needs to monitor if the distance sales threshold is exceeded or not for each country it ships to. After Brexit, import VAT is due on goods with a value above €22. But a few months later, import VAT is only due on goods with a value above €150. For goods with a value below €150, the German marketplace is the deemed seller for VAT, and the supply by the UK vendor to the marketplace is VAT exempt. So now the marketplace needs to know the taxability of all goods sold via the platform by the UK vendor. But what happens if the UK vendor uses a fulfillment model with stock located in a warehouse of the German marketplace? Under the current rules, this implies the UK vendor makes supplies from a German warehouse to German customers. These are domestic supplies in Germany for which the UK vendor requires a German VAT registration. After Brexit, this is still the case. However, as the UK vendor is now non-EU, he may need a local VAT representative. And once the new e-commerce rules apply, the UK vendor only makes a VAT exempt supply to the German marketplace. And many countries do not allow a local VAT registration in case no output VAT is to be reported in that country. And this may result in the UK vendor having to reclaim German input VAT via a separate request procedure. This is all I wanted to share with you on a very high speed format on the EU changes. And if you assess this in relation to your own business, probably quite some questions will arise. But now there is still time to prepare for all of these changes and anticipate. So thank you for your attention.
Yeah, thank you, Peter. Definitely a lot to take in there.
Yeah.
you know, it's obviously, if anyone would like more information, I would suggest you visit the virtual expo and get in touch with the team at Vertex. I think I've got time for maybe one or two questions, which I might ask. You talk about marketplaces, you know, it's a growing area where we're seeing a lot of people trying to create marketplaces because, you know, they feel that there's a gap in that area. But why are marketplaces becoming deemed sellers for VAT? You know, that was something that that came up. So I don't know if you could elaborate a bit on that.
Yeah, that's an obvious question, because it implies quite an admin burden for these marketplaces.
Yes.
But it has been the case up until now, basically, that a lot of sales through these marketplaces actually do not trigger any VAT. Yes. So a lot of VAT is not collected for sales that go through the marketplaces under the current rules. Yeah. And yeah, this creates a serious competitive disadvantage for European vendors, and also for non-European vendors who are compliant with the rules. And it has proven quite difficult to collect VAT from vendors that are not established in the EU and are not willing to register. So that's why marketplaces basically are drawn into this field.
Sure. Yeah. Okay. And then another one. Obviously, will these new rules also affect any B2B sales? Because, you know, there's a lot that happens for merchants that have sister companies in Europe, and, you know, pull in sometimes stock.
Yeah.
There. So how would that work?
Actually, nothing will change over there. So these new rules only apply to business to consumer sales, and if you are, let's say, selling to both types of customers, you will basically have to apply two regimes. But that is also already the case actually now, because also the current distance sales rules only apply to business to consumer sales and not to business sales.
Sure.
So most business to business sales cross-border in Europe are zero rated, but it's important also under the new rules basically to monitor whether it's business to business or business to consumer.
Okay. Wow. Well, very useful, Peter. Just a reminder to everyone, the talks are recorded. So if you do need to get more information on those, please look at the talk again and probably pause and understand the concepts. Thank you for your illustrations. I think they were very well articulated for people to understand. So I think you're probably going to get a lot of people watching this on a preview later on.
Let's hope so. And thanks for the patience of staying in for a compliance-related topic.
No. It's useful, and I think it's important for merchants to understand this, and they have enough time to make changes. So thank you very much for your time. And our next talk will be up in about 10 minutes time, and that will be Clavio, who will be walking us through the customer's shoes across all channels. So I look forward to you coming back for our next talk. Thank you very much, Peter.
Thank you, Yannick. Bye.
Bye.